Good afternoon. Can everybody hear me? If you can't, you'll raise your hand. Before we get into our conversation, which I hope is going to be a conversation not just between 5 of us sitting up here, but with all of you, could I just present to you our panel, which is first of all, Klaus Sliebisch, who is the head of leasing for ECE Group. Then Laurent Morel, who is the CEO of Klépierre. Alan Barocas, who is Senior Vice President of General Growth Properties. And Alan, let's give him his proper name, will be giving us the point of view from across the water in the United States. And finally, Jaak Blokhuis, who is CEO of Multi Corporation. All of you, think back 20 years, how old you were then, and what you have done in the last 20 years. Now think of what you can do in the next 20 years. And today what we're going to be doing is we're going to be remembering what has been happening over the last 20 years in the shopping center industry. And we're going to try and see what are those trends we believe will carry on, and what are new trends which we can see are beginning and will actually be regulators of our industry for the next 20 years. And perhaps even, we might actually say there may be 1 or 2 new trends which haven't yet appeared, which might do so. So first of all, Jaap, if I could ask you, from the point of view of lifestyle, what have you seen in the last 20 years?
If I look back over the last 20 years, it's just over 20 years ago that I returned from the United States, where I lived for a short while. And at that time, coming back in the Netherlands, life was sort of maybe traditional, peaceful in terms of looking at shopping center business and retailing. During the week, you went to the grocer and the butcher and whatever, and in the weekends, on Saturday afternoons, you were buying a bit of fashion every now and then, and that was a sort of very traditional pattern. I think what has happened over time, just looking forward a little bit, in the course of the 90s, I think we've seen the first indications that our way of shopping would change, with the first signals that internet became a bit of a force. I remember the nervousness of the late 90s. We had a sort of hype about everything that had to do with computers and IT systems around the year 2000. We had a bit of an IT bubble and also a bit of an IT crash in the early part of the first decade of the current century. And then if you visited conferences, everybody would say, you know, it's not that bad, you know, internet retail, it will not really take off. So there was a sort of relief in the industry. And I think it was a little bit back to normal, and we started to sleep. And then, of course, the crash came of this 2007, 2008. And today we know that life is completely different. And in terms of lifestyle, operating, households, demographics, our world is totally upside down. Maybe I shouldn't say too much about it. There's colleagues who want to add, no doubt, but I think that's a little bit the headline.
Alan, in the United States over the last 20 years, has it been a time when the industry has sort of sat back and just evolved, or has it actually dynamically been changing?
I think it, excuse me, I think it has been changing, but just one fact about 1995 that I think all of us can really understand. It was the introduction of the Frappuccino by Starbucks. So it started in 1995. So if you think about a business that has grown from a modification of just coffee to Frappuccino to the multitude of recipes that we order every day, you see that this is a different world. I think, you know, if you think of 1995 back in the States, it was a period of growth for retail. Specialty retail was in the middle of an amazing growth rate. I spent 25 years at the Gap stores, and I was there in 1995. So I saw, you know, the Gap grow there. I saw specialty teen concepts grow. Today, they're having some issues. The department stores were strong. You had more of them. But it was single channel 20 years ago. as opposed to an omni-channel environment today. So you had different challenges, but still it was about leasing, it was about growth. A lot of the mature companies today were still in their beginning stages to middle stages of growth, so it was a very prosperous time for us back in '95.
Laurent?
Well, the major evolution when it comes to lifestyle and with consequences on our industry, I would say in the last 20 or 10 years, I would give two. With again, major consequences on our business. The first one is the demographic trends. We no longer look at demographies and demographics on a country-by-country basis, but on a city-by-city basis. And you can see a lot more of polarization, with some cities growing, having all the assets, trains, universities, demographic growth, and some others just collapsing. And that has very strong consequences on our allocation of capital. This is a fact, for better or for worse. This is what we will have still, this high polarization with some cities taking the lead. And you can see that very clearly in Europe. And as I hear, this is also the case in the US to some extent. So that's really the main focus, that has been the main focus on our capital allocation in the latest years. We have clearly sold out some of the regions and acquired more in the regions where we were already strong, because we have those trends. Second trend is, I would say, the way people shop. I would say they used to go on Saturdays to their main shopping destination, and today they shop anytime. They shop in between the working day. They shop while they are traveling, and Gare Saint-Lazare is a very good example of that, or all the shopping development we see in the airports are also a clear demonstration, evidence of that. We have huge successes in shopping centers in touristical destinations. People shop a lot while on vacation. You know, people live part-time at work, in their on vacation. The lifestyle has changed a lot, and people shop everywhere and on their travel. And I think the internet is increasing that nomadic attitude also, because the products are available all the time. So people get to know the product, and their process of buying is much longer and much more complex. So you have to be on the path of customer as opposed to being in a destination. And this is the major trend I see.
Klaus, and before I actually ask Klaus to say something, please, if any of you want to butt in, just put your call out and be part of this conversation. If you've got something, sure, there will be time at the end, but also no problem if you want to actually, start involving yourself in the conversation with us right from this moment. Klaus, it's your go.
Thanks, Christopher. I think the major driver from my point of view concerning shoppers, business life, whatever it is, since the last 20 years is information. Information and the speed of information, how you treat this information, how you treat, let's say, the transparency of information. And I want to give you an insight what I've done 20 years before. I was a leasing manager for a certain project in Germany. And then I drove to my, let's say, tenants. I tried to convince them I had to deliver information. What is the reason how to enter a shopping mall? What is the advantage? What's the disadvantage compared to, let's say, high street, whatever it is? I have to transport information. That has changed because the information is already there when I do my first appointment. Another nice story, to make it a little bit more in pictures. I remember very well a famous discussion with my boss at that time. He was a director for a region. We have been successful. We have been young leasing managers, and we asked him for an investment into something which is called mobile phone. We had a feedback meeting in 1995. I know it really exactly because it was a tough meeting, because we young leasing managers asked for, let's invest in mobile phones for our car. Maybe some of you remember these big boxes when you carry out the mobile phones. His reaction was a little bit more or less disappointing, because he listened, you young leasing managers, grab more signed contracts before discussing status symbols with me. So he said, okay, put a bit more, let's say, effort in your daily work before discussing some technical gimmicks or something like that. And it has changed, if you can imagine. As therefore, information, how to deal with information, that is our topic, and it changed our life, let's say, tremendously. And that is what we have to do in the near future as well.
So we've basically seen in the last 20 years, we've seen huge technological change. We've seen brands changing, and we've seen new brands become truly global brands. We've seen, certainly 20 years, I remember being here, and we were talking about Europe. And for us, globalization basically meant Central and Eastern Europe, we're going to start being able to work together. And those were the issues. China was hundreds of thousands of miles away. It just didn't even feature. Today, we have a lot of companies who are out there with fantastic stands from China, from Asia, from South America, and all the rest of it. Now that we've actually reminded ourselves a little bit of where we were among certain things, where do you think we're going? We were talking about, effectively, 20 years ago, we also were talking about shopping as an experience. Well, you know, is it a great experience? Are we going to have even more experience shopping? What's the next thing? Alan?
Yeah, I think if you step back and you take a look at the retail environment, at least in the States, and I'm not sure it's any different here, you know, we hear a lot about customer experience. 20 years ago, you never heard that from a landlord. It was always just about shopping. But it is about what's the experience for our customer today. And you have a situation where for brick and mortar, the internet is competition, Amazon, Alibaba. So when we sit back and we say, what can't they provide and what can they provide, it challenges us to think a little bit more creatively and out of the box. So for example, I was in a taxi a couple of weeks ago and had a conversation with a cab driver about e-commerce. He only buys online. And why? Because he gets free delivery and he gets free returns. That's the only reason he shops online, and that's what he prefers. So what do we need to do to address that? For example, we have set up in the States, with some of our fellow shopping center REITs, what we call same-day deliv, where the customer could come in with a participating retailer, buy their product. It's then carried over to our same-day deliv area, and we deliver it free of charge within the market. It's within 24 hours. So that challenges the service that internet is given. Internet cannot feed our customers. So all of us are spending more time. We're taking a look at our quote-unquote food courts, and we're turning them into dining experiences. Different offerings, chef-driven, celebrity chefs, et cetera, if it's right. We are also adding more restaurants to our malls, and non-retail uses, medical clinics, libraries, entertainment. We have a saying in my company: we want to feed them, we want to entertain them, we want to give them great offerings, and then we want to give them an opportunity to have a great experience within the center. And more than just in the November-December period, 12 months out of the year. So that's where we're headed.
Can I just fill in a little bit on Europe? I think if you say free delivery, free returns, that's also the weakness of internet, because long term it makes it an expensive business model.
And that's good for brick and mortar.
Yeah, so at the end of the day it will be a mix and it will be cross-channel and whatever. But we're in a phase where internet is really buying in, and I think there is plenty of research these days demonstrating that the pure online player is losing ground. Because at the end of the day it's very difficult to survive as a pure online player. So there is a future for retail real estate, that's clear. What I would like to add as well is we have to be realistic about where we are in the market, because there is a lot more going on. I think if you look at the demographics, indeed, Europe is not growing anymore, certainly not in terms of labor population. We are an aging country or an aging region. If we talk about what we've done in terms of shopping center supply, you know, it has been exploded over the last 20 years. So there is a huge gap in terms of supply and demand trends. So it was unavoidable at the end of the day that we enter in a world of winners and losers. Not everybody can win, so it's becoming a very competitive marketplace, and that makes also the difference in terms of how we can approach, how we have to approach the retail real estate industry. You cannot, as an institution, say, you know, I buy a bunch of shopping centers, I hire a manager, and every quarter I will see how it's running. That's over. We have to sit on top of it, and we have to manage it extremely carefully. So it's all about design, it's all about experience, it's all about changing models. If you look at just trends over the last 5 years or whatever, and there are famous graphs just demonstrating that in terms of physical sales, the trend is down. If you look at what's sold in Europe, physically, goods, shoes, electronics, whatever, it's going down. What's going up? It is everything that has to do with services, entertainment, etc. So our properties have to grow with that new reality. And that's a huge change, and it will continue to do that.
All what you said is right, but I would like to steer the discussion not too much into the direction of online and offline business, because it sounds always that there's a big competition and we are fighting against each other. The discussion should be how should we define the shopping experience. So maybe it's always easier as it is in life. So from my point of view, shopping experience for the people is make life just a little bit nicer, just a little bit easier, and maybe sometimes a little bit more surprising. If we concentrate and focus on these things, then we are absolutely in line with all these new appearing, let's say, formats, and then we can be friend of it, and then it's not a kind of competition. So there is always a pendulum swinging, which is good and which is not so good, and is always a trend, and there's a trend against it, and we have to focus on it. And if we focus on the daily work, make life a little bit easier, make life a little bit more convenient, or let's say more nicer, then we will survive. So there is lots of chances, lots of ideas, because tomorrow, please be aware that there's another one who stands up, call him not internet or whatever, maybe another kind of retail format, whatever it is, and then we are again faced with new challenges. And just focus on that, and people will appreciate very much. The daily shopper will appreciate if you make life easier and a little bit more nicer, then he will be back tomorrow in your mall, and that's okay. Add it with all these things from services, from gastronomy, and there's a change. And if you look back 20 years, how the branch and tenant mix in our malls have changed. That has, it was the same situation 40 years back. And if you all remember, we can read books who was not on Earth at that time. That was a tremendous change all the time. And tomorrow, the tremendous change will start again.
How do you think that, now we're talking about globalization, that what we have learned in either North America or in Europe and Western Europe in particular over the last 40, 50 years, how much does it actually mean something for us when we're looking at China or when we're looking at the Middle East or Turkey? You, I know, who are working a lot in Turkey, and you too, Jaap. Is retailing getting more and more same size fits all? Laurent?
Well, probably, yeah. The trend towards globalization is still very strong, and we all know the major players of our industry. For example, in the fast fashion, there are still the same series of leading companies, and those companies, those 10 leading brands, still have the higher growth, the higher EBITDA, are still taking market share over the others. So yes, the trend towards globalization is still very strong.
So basically, we're going to be seeing development in obviously the emerging markets, and we're going to be seeing greater sophistication in management on the more mature markets, where you can't just rely anymore on new shopping centers, but you've got to rely on improving your present ones.
I'm not absolutely in line with what you say. I think Europe looks like a flat environment, but this is not true. The average flat does not reflect the very strong trends from one city to another. Some are growing and some are just shrinking. And if you look only at average, you don't get a right sense of what's going on in the market. That's the same for retail. For France, for example, the average sales are flat. It's 0%. But in fact, it hides some very strong differences between the winners and the losers. And the winners continue to have double-digit growth on their sales and continue to gain market share and to continue to make profits at the expense of other ones. So we are in a highly changing and polarizing world, and our business is to take the good waves. And inside a market that could appear a bit flat, there are many, many opportunities to allocate your capital in the best way.
I would say that in the US it's a little bit different. We are spending a tremendous amount of capital on our existing assets. You know, the number of new malls that are being built in the States, you can probably count on one hand, where 20 years ago there could be 10 or 15 that were being built on an annual basis. So for us, it's examining our, and when I say us, I'm talking about the majority of the REITs. We're spending capital on our existing assets. It's less risk because we have an idea of what will succeed, what doesn't. We are the beneficiary of some great global, retailers that help us with our expansions or re-merchandising, whether it's Zara, H&M, Forever 21, Lego. Now Uniqlo is making a presence in the States. So for us, it's not about new mall growth. It is about redefining who we are and taking our existing assets and raising them to a point where they can actually meet the potential of the respective market.
Yeah, but if I may, you don't grow all of your assets. You choose the one assets that you grow, that you spend money on.
You do.
Well, it's the same thing. I mean, when I say it's not only about greenfield development, it's about spending the money on extensions, on the right locations at the expense of other ones.
No, you're correct.
Yeah.
Yes, it's a.
For me, the big surprise is, if I go to the US, but correct me when I'm wrong, Alan, that the market there is still very much, the shopping center market still very much determined, or the layout of shopping centers is determined by the existence of department stores. Of course, the new generation of lifestyle centers, which are open air and not covered and whatever, that's a different breed. But if you look at the traditional centers with 6 or 7 different department store chains still existing, where in Europe you've seen them virtually dying. There are still a few left, but not many of them. And if you look at the number that are really healthy, it's quite limited. So I think we are also forced from creating the sort of traditional shopping schemes based on 2 or 3 major anchors, and in between you are running up and down. That concept is gone. We have to create an interesting business environment for every retailer. And in a shopping center today, if you look at Forma Radunia or whatever in Poland that we are developing now, one of the conditions of the bank was that we had agreed terms with 8 anchors. And the anchors are the supermarket, and it is the cinema, and it is the food court, and it is, sorry, it's 4 major retail fashion chains. I mean, it adds up to a sort of interesting climate, which is much more spread out than the traditional polarized structure of shopping centers.
I would agree with you, but what's happening in the States also is with the demise of many of the anchors. I mean, we take a look at Sears. You know, Sears right now is, from my vantage point, in the real estate business. But when you lose a department store, what we're doing is we're either upgrading that department store to another use. You know, for example, we bought 11 Sears locations. 3 of those Sears locations we converted to 3 Nordstroms. So if you had a center that was a Sears and Penny's and Macy's, now you had a Macy's, Nordstrom's, and Penny's. So you're able to upgrade it. But more importantly, we're also taking these anchors and we're re-demising them, either knocking them down, re-demising, to your point, adding entertainment, adding food, adding what is considered non-traditional retail to enhance the customer's experience in the marketplace. So that's going on as well. It's, I would agree with you that, historically, it was very simple. You plotted in your anchors and you merchandised around it. Now, the great anchor, you're left with probably 6 department stores, 6 or maybe 7, I might be missing it by a number, in the States that are still thriving. But it's the specialty that is driving the center, but it's also the non-traditional retail, like food, like entertainment, that it's making it a destination for the community. So I think we're almost saying the same thing.
Yes, I think that the moment that a shopping center stops becoming a place to be, then it's having problems. But what's interesting is to see how the relationship between the owner and the anchor tenants, let's just talk about the anchor tenants, not the tenants, but the anchor tenants, has evolved over the last 20 years. 20 years ago, you had the gallery, And in much of what the British call continental Europe, you had hypermarkets. And the hypermarket was there. He was doing his job as a good hypermarket grocer, and that was it. What has happened? The hypermarket is now as much a property investor as Klépierre. I think Klépierre knows about that. And therefore, we've seen how, indeed, even 20 years ago, the investors who owned shopping centers were very passive. At the time, Klépierre was really called CGC, and CGC was just an all-powerful manager. CGC,
all yourself.
It still is. And what has happened? Actually, now everybody talks about Klépierre as the owner doing his own management, and talks about Carrefour being Carrefour Property or Carmilla. They tried it in the States. If you remember 20 years ago, some Canadian, I've forgotten his name, who had most of the department stores, started to want to become an owner also.
Campo.
That's right, Kempo.
I was around then. I'm sorry.
Yeah.
That's when this panel.
But if my memory serves me right, his model, which was to actually be owner, tenant, doing everything, didn't work. How do we see this continual change in terms of ownership? How are investors themselves going to change? Because they have changed tremendously in the last 20 years. Or do we think that they've actually now arrived at the level which will be still here in 20 years' time?
Well, if I may, I think it has to do with the change in retail itself. You were speaking about the hypermarket that have been the leading retail format for 30 years in France, for example, to the extent that they toppled really the department store business. What you can see now that those hypermarkets are still very strong, but they have, in a way, focused more on their food offer at the expense of other retail products. So then they leave room for other category killers like the fast fashion anchor. So we are in a perpetual change in our business, and the latest trend is to see the growth of people like Primark, which do an extraordinary development recently. So you see, our business is extraordinary. There are new players all the time, and the name of the game is really to take the wave at the right moment and to make sure we anticipate the trends. That has consequences on the way we work with those retailers, in the way we manage those centers and own those centers. But at the root of that are the changes in the retail itself, which are still very, very important.
If I may add something, I think this change has to do with some kind of professionalism. So if you see, there are some reason why they are not owner, tenant, and operator at the same time. So you have lots of conflict of interests if you do this at the same time, and you should manage it. And there's always one in that row who may do it slightly better than you do. And I think it's the pressure from the economy to find always the best level, the best in class. Therefore, you need the best owner, you need the best retailer, and you need the best operator. If you could combine that at one stage, you are a lucky one. I've not found one so far. Maybe that is the reason that there's a share of work between these, let's call them, three parties. This was different in the past, and I think that will never ever change again, because the more we look in the future, the more we go into details, the more we are, let's say, forced to be professionalized. And I don't feel capable to do everything in one step. I feel good as an operator. I see lots of retail do a fantastic job. I rely on what they are doing. My job at the end is to combine and to link between these three parties to make the best result out of it.
Yes, I still come back to how in the next 20 years the investment market is going to change. A recent example, Hammerson. 20 years ago, Hammerson had shopping centers in North America, in Australia, and in Europe. And it and the investors behind Hammerson owned those shopping centers. Nowadays, Hammerson has gone back to just being in the United Kingdom and in France. And if we're going to understand for the future what they're going to be doing, their latest acquisition in France, they've bought a very, very big center, I think in Nice. They've only actually bought themselves 10%, and I think Allianz has bought the other 90%. So there was a pure investment player who's going the other way, who seems to be going back to saying, actually, my own core business, I want it to be as an asset manager. I will be involved because I will have a good 10% of each of the centers that I'm involved with, but I certainly won't be the owner. So, you know, we've seen the Klépierres getting stronger and stronger, and the Unibail-Rodamcos, all the rest of it. It'll be interesting, and I aim to be here to see it in 20 years' time, if that is still, you know, and
I'm sure you will be here.
They will, I'm sure, but they will have changed. Because if you don't change, you die. I mean, it's as simple as that. That's not the end of the conversation, by the way.
No, but to say a word on that, Christopher, I think we are a highly capitalistic business, probably the most capitalistic business in the world if you look at the capital employed by the number of employees. So evidently, the decisions we take and the very first responsibility that we take is capital allocation and the way we invest the money of our shareholders. So I think no wonder that the specialists, longer term, on average, make better choices and better operations than others, occasional investors. When I say specialist, and that's the rationale of a REIT like Klépierre to be, or like Euroshop or other people like this, or GDP, specialized in one single type of assets makes you better, makes you stronger. Specialized in one geography makes you also better in the knowledge of the environment. And at the end of the day, that's what makes you globally better in your choices of allocation and in your management skills.
I agree, but we're all really interested to see the first real European-American joint venture, if I can put it that way, Klépierre again. And that's really interesting. Now, yes, I think that also is part of what we're going to. We're going to see more groups who are really involved transcontinentally.
I think Blackstone Multi might be an example. But having said that, I think what is coming from the United States is very much the focus on financial performance. Apart from the fact that, of course, they have a great skill set in terms of how you run shopping centers. But what you see today is, of course, a very strong inflow of private equity money into Europe. And it's very much focusing on the new financial settings in Europe, and they have changed a lot. And I think that's a very interesting opportunity or a very interesting development because it creates a new playing field. We are more or less on the crossroads of saying goodbye to the traditional institutional investors who run their shopping centers in a different way and see how new money is coming in, but they only want to get in if business is run in a very professional way, in a dedicated way, in a committed way, and it's absolutely different from what it used to be. If you talk about US and Europe in terms of combined marketplaces, I don't think that's going to make sense. If you go to ICC in Las Vegas, and some of you may do, it's a complete American story. And if you want to find a European retailer, if you look very carefully, maybe you may find 5, sort of maximum. So I think the financial markets have already sort of integrated. The real estate markets do not, and I can't see that's going to happen short term.
And I would just add that the one area that I think impacts our investment decisions going forward is really going to be the health of the retailers. And that's the one concern I have. And can they sustain growth? Can they sustain enough growth, which will translate into productivity, which will translate ultimately to the types of rents that we can, we can expect? That, to me, is my biggest concern. You have macro elements, you have political factors that are out there, but unless the retail community can reinvent themselves as well, because a lot of this is being pushed on the owners, but I challenge the retailers to try to reinvent themselves as well, because there's, at least in the States, there's a lot of sameness there. There's not a lot of differentiation. One of the reasons we're here, this is our first MAPIC, is to try to understand what else, to get visibility to other retailers that are, available who might be interested in coming to the States. But unless the retail community starts to understand their business and continue to reinvent themselves and continue to improve their customer experience, within the marketplace, I think there's going to be some real volatility in the investment market, in my opinion.
Well, sorry, I don't exactly share the same view. I think there are some, and a large part of the retailers reinventing themselves and still growing. We were talking about H&M, Zara, Mongo, Primark, Uniqlo, to name a few, which really have exceptional growth in a difficult environment. Why? Because they have changed themselves, they are very aggressive on price, on products, and they are as successful in the US as they are in Europe, by the way. So it's just that they represent today less than half of our customers. But their numbers are growing, and it's just that the world is changing, and we have to accelerate that and make their proportion in our malls more important. But I think there is transformation, clearly. This is what we see.
I would just say, my friend, that the difference is that H&M and Zara may not be new companies in Europe. They are experiencing tremendous growth in the States. So by comparison, I'm not necessarily talking about them, okay? I'm talking about the mature retailers that are in the States that need to reinvent themselves. H&M, once they get to 500, 600, 700 stores, I'm going to challenge them as well. Right now, they're not.
Yeah,
can we agree on that? See, we can agree across the pond.
Yeah, we do.
Okay.
We do.
Don't forget Lafayette. Got myself off my stride there. Mom and pop operations. Many people believe that, and indeed the customer himself, all of us on Saturdays or whenever we have time to go shopping, actually, we love all the brands that we've already mentioned, but we do sometimes like to find a new brand that hasn't been thought of before. At the moment, do we really think that our lease structures, if we sort of put on our investor hats, are sufficiently flexible to allow us to give a chance to some newcomers who may not be greatly successful, but they do bring the salt and pepper to the merchandising mix? And the second thing I would say on that, perhaps knowing that there are a number of institutions who are actually now looking at a real new lease structure which properly takes into account e-commerce, may give us the opportunity to completely review a new form of standardized lease which will take these matters into account.
I would start if I'm allowed. So that's a very good question. I like it because one of your questions was, have a look back 20 years and what has happened with Mama and Papa stores at that time. So we had no big change. We have no, let's say, cross-border international expansion. You have to be forced to find these so-called Mama and Papa stores, which was good because we walk down the street, we find a store which looked good, and we ask them to open a second store in our mall. Fine. What has happened in the meantime, and this is what I mentioned as professionalism, as a retailer, independent how many stores you have, there's two things you should achieve. One is you should have a very, let's say, emotionalized business. You should touch the shopper every day, independent which kind of good you sell, what you're offering, what kind of service. You should touch on the emotions of the shopper. First thing. Second, and this is a big challenge for the retailers, you have to have a systemized organization. So you need a clear sourcing line. You should know where to buy the products. You should know how to operate a store. You should know how to do the accounting, how to do the merchandise end to end. And this is for sure a real big problem for a single standing unit doing, let's say, some advertisement or whatever it is. But there is a chance, yes. I think there's a big chance for us to create new branch and dynamics and new lineup of retailers, because if you start naming the most important retailers, you may have two hands, but you have 200 stores to lease out. So if you have done the lease with H&M, if you've done the lease with Inditex and done the lease with Primark and then you need another 195 ideas and it should be, let's say, this is the service and the power of the leasing team to do this, to find these mama and papa stores. We should rename them because there are lots of nice examples all over the world, whether it's in US, whether it's in France, in Netherlands or in Germany, where we find these, let's say, startups, and we should help them. I don't like the discussion about defining a new lease structure, lease term. Why? Looking back 20 or 30 or 40 years, we started this discussion with our mama and papa stores. How should we define the contract? What are, let's say, the principles? What are the lease terms, or how does it look like? The only things that has never ever changed is that the major principles of a shopping mall operation, which is, let's say, having a defined branch and tenant mix, show us the offer for products and services, open the store at a certain time, that this is a convenient let's say timing for the shopper, and let's say a handful other ones. The rest is legal discussion. So I think it's a good change if we switch back from legal discussion or leasing structures with, let's say, pages and hundreds of pages, back to the principles and do a proper work. Why? Because what is the case? You have a signed contract, thick like a book, and there's a problem occurring. You can say, okay, let's look on page 67 what's written in the contract, but it doesn't matter. You have to go into the discussion with your retailer, with your shopper at the end, and let's try to find a solution for tomorrow. And therefore, we don't need new lease structures. We need new, let's say, forward thinking how we cope the situation, that we add online and offline together, and at the end there will be a final good result. The only thing, and everybody in the room knows that, everybody talks about these so-called pure turnover-based deals and all these nice issues. Yes, there's a discussion ongoing and how we can solve it, because it is something that has to do with risks and something that has to do with, let's say, an outlook, how could we operate properly. Concentrate on the major things, not on the things, let's say, on page number 67, that's it. Sorry.
Well, that went by very, very quickly. I haven't seen anybody put their hands up. Would anyone like to put a hand up now? And either put a question or indeed say your piece. Okay. Yes.
Can I just add a little bit to, I think, Klaus, we are very close, but I think we are really living in a sort of period in the shopping center industry where we say goodbye to the shopping center as a collection of cash flows. Long-term leases with a particular certainty about rent to be paid and whatever. I think the future shopping center market is far more dynamic. It will be a lot more short-term leases. Today, you want to have a couple of Inditex leases, you want to have an H&M lease, and if you have that created, then you have a start of a new shopping center. For us, as real estate developers and investors, that's a very tricky situation. You want to have something completely different. Of course, you want to have those tenants in. They are important. But we are very close to the point where we are killing the Papa Mama stores. And that is really dangerous. We already created 7-day trading in a week, which is impossible for a family business. We created all sort of legal structures, long-term cash flows, levels of security. And I know as an investor, you like it. And your shareholders, they love it. But if you see real estate or shopping centers as a business, you have to come at a higher level and say, you know, this center is so powerful. It has so many different elements. It has so many different angles where you can look at it. It has so much entertainment. It has so much experience. I can do with short-term leases, long-term leases, flexible leases, turnover leases. And of course, turnover leases are not that easy anymore since we have a little bit of online turnover as well. But it's going to be a completely different world. At least that's my feeling.
You're right. Just one comment on that. We have to face with the question, what is our role indeed? So we have this challenge at these days. Are we investor? Are we operator? Are we a finance company? Are we whatever? What else? Sometimes we have a role and we have to manage everything. And our daily business is to combine all these things, because we are all the day in a dilemma. Because you have would say the demands from finance side, you have the requirements from the banks, you have all the demands from retailers, and at the end, that was in the past. That is the same today. Today is one difference. It's a bit more intensive, and we have to talk about these things all day. And that will never change, and it will. And that is our job. Therefore, our role is, let's say, to link it and to make the best out of it.
Well, it looks as if our time is up. Thank you, all of you, for sharing in our conversation. Carry on talking with us, but outside. Thank you very much. And thank you very much for my wonderful panel. Thanks a lot.